My dear friends, I recognize all of you, and it's been a long time. I would like to thank FinTech Robos and founder and big boss, Sir Ibrahim, and his team for organizing this important platform for this very crucial topic. I hope all of you have a sound and sustainable pension fund, as I know that you are working to have humanity enjoy such schemes. As you know, my organization, the International Peace Institute, has been working with Mr. Ibrahim in his former functions for several years now on this important concept of how sound pension schemes could contribute to social peace within a country, as this incorporates or should incorporate a holistic approach that establishes a connection between peace, society, security, and financial development, therefore sustainable development. Simply put, this global pension funds crisis that we are witnessing all over the world, with very, very few exceptions, if it's not solved in the immediate future, it will threaten the very fabric of social and global peace. This is not a way of exaggerating or over-exaggerating. This is the truth. As you all know, you are the experts in this field. It is without doubt that finding a solution to the crisis or the pension crisis is a prerequisite, as I said, for social peace, especially considering the future provision of pensions that affect the global population on a multi-generational scale. We have, with Ibrahim, reached the conclusion that the population of the retirees is growing bigger and bigger. It's becoming a population. And this population, without a decent source of income, it will become a source of unrest and crisis within societies. The MENA region, as you know, is experiencing a drastic shift. Over the past 50 years, the region has experienced the highest rate of population growth, creating, I would quote, a youth bulge, which will have significant ramifications in the coming years if left unaddressed. And I think we count on you here to provide us with the tools of addressing that properly. Parallel to this youth bulge, the global life expectancy has steadily increased. And I'm now not inventing the wheel among experts in this domain. In 35, 40 years, the youth will climb the population pyramid to create a surge in the geriatric population in the MENA region. According to the Millennium Feasibility Report, individuals over 65 in the MENA region will grow from 10 million to 70 million by 2050. We must also keep in mind that unemployment rates in the MENA region is at 25%, exceeding that of any region in the world according to the International Monetary Fund. The current coronavirus pandemic has undoubtedly greatly added to that percentage of unemployment on a global scale. This is another matter, of course. This means that with greater life expectancy and significant unemployment, this will increase the already simmering pressure to generational tensions over limited public resources in this part of the world. 90% of the world's working age population is already not covered by pension schemes. And if we do not realize the volume of the crisis with this figure, I think we are losing it. Compound that with current social upheavals, crises and furloughing, and the frustration will inevitably boil over to severely jeopardize and threaten social stability and peace. As the medics say, an ounce of prevention is worth a pound of cure. And you are the medics here, my friends. I look forward to hearing from our panelists, who are all experts on this field, as to the situation in the Middle East and North Africa region with forward-looking assessments. I will start with you, Phillip, by saying, I need 1 hour to introduce you, but I will limit myself to saying Phillip is the senior manager of Ernest & Young. Phillip, in some major economies, the funding gap in government pension funds exceeded trillions of dollars, huge amounts. And in many countries, the deficit we're talking about in the magnitude of hundreds of billions of dollars. How much has COVID-19 worsened this situation? Thank you, Phillip.
Thank you, Mr. Nejib. If we could just load the first slide, just to help illustrate some of the issues here. It's worth focusing on some of these just to be able to bring them together. Whilst we're waiting for that to be loaded, it's fair to say that COVID has had a wide range of impacts on defined benefit pension funds. And in order to be able to try and think about how these can be considered in isolation and also in aggregates, I always go back to basics. And the basics that I think about are the way in which you achieve financial balance within defined benefit pension schemes. And fundamentally speaking, contributions plus investment return must at least equal benefit payments and expenses. It's a self-evident truth in order to be able to achieve financial balance. And then by considering each of these four categories, we can actually look at the way in which the impact of COVID has had on defined benefit pension funds over the region. Second slide, please. Perfect, thank you. By thinking about each of these factors, we can then have a think about what the potential impact might be. And I'm obviously fully aware that there's a degree of uncertainty about what might happen over the medium and long term in some of these issues. But let's pick up on that as we go through each of these. So when it comes to contributions, yes, it's fair to say that COVID has accelerated the turnover of the subscriber population. Sadly, some people have lost their lives. Some people sadly have lost their jobs. And that impacts the active population. But it's worth remembering that there's two elements to each of these. What you find is that they were paying contributions, yes, but they were paying contributions to cover more expensive accrual. And certainly if they were older, much more expensive accrual, because accrual is highly age dependent. So if someone retired, or someone sadly in the higher ages lost their life due to COVID, yes, they stopped contributing, but in fact the accrual of benefits was actually going to be more. So, and looking at it from a purely financial perspective, the scheme may have made a gain where a new entrant comes in on a much lower accrual rate, or if they weren't replaced at all, the actual you're not adding to the deficit. So a mixed bag for contributions. However, the big one is investment return. Investment return is big because it actually contributes 2/3 of the total assets of the fund, and it also tends to be highly volatile. And that top line is the one that I would encourage you to focus on, because the value placed on liabilities is driven directly by long-term bond rates. And that has seen a high degree of volatility over 2020. And we'll come on to that later on. And the reason why I've actually put a square dotted red line around that box is that by far the biggest impact that's taken place on the finances of pension funds is due to the impact on investment return and the forward-looking rates that of return that you expect by looking at the financial markets. when you come on to benefit payments, actually, it's a story of short-term shock and longer-term uncertainty. Yes, sadly, a lot of people in the retired population in the initial stages lost their lives due to COVID. However, the medical profession has started to catch up. And whereas when you first went into ICUs, intensive care units, in the early stages of this horrible disease, it was very quiet because everyone was in a medically induced coma. Nowadays, it's quite loud and noisy. People are just waiting for the symptoms to pass because the medical profession has brought up a broad range of measures to be able to inhibit the worst excesses of this horrible disease. And indeed, if Pfizer's new vaccine turns out to be everything that it's promised to be, then it could well be that with large-scale vaccination approach, we could find that this turns out to be no worse than a case of measles in the future. Let us hope that that takes place. Whether or not there's been a step change in our lifestyles could also improve life expectancy in the future, though, and this is the area of uncertainty. If we're going to use cars less, we're going to work from home more, we're going to exercise more, it's going to increase life expectancy. That means you're going to increase the period over which you pay pensions. That's going to increase the cost compared to what you expected to pay. There's an element also about how it impacts retirement rates and mortality and job turnover as well. If we're all working from home, what kind of lifestyle impact does that have? The implications there as well. So there's quite a few bits of uncertainty there. However, the benefit payment structure is fairly rigid, and so long as there are protections in there to ensure that whatever mechanism is used for people to actually start claiming their benefits, that there is no excessive selection against the fund, then there's a degree of protection, certainly on the benefit payment side. Now, running costs tend to be a fairly small proportion of total costs, 2 to 4% in general. And so whilst there may have been one-off or perhaps longer-term reorganizational costs that have taken place, say that was a 10% increase, that's 10% of 2%. It's not exactly going to be a large cost in comparison to, say, what the investment return element is indicating. So let's move on to the second slide, because that focuses on the investment return impact. And this is the one that actually has the more magnificent impact on scheme finances. I mentioned 4 elements in the first slide that make up the drivers for the investment return elements. And these are now split into the 2 graphs that you see on the top row. 2 of them drive the asset values, effectively bond values and real asset class growth. What you can see is that certainly over 2020, the blue line for bonds, that has actually improved. People have sought out security. So bond returns have actually shown quite a decent return in comparison, maybe 10 to 15%. However, real asset classes, certainly equities in Q2, showed a pretty horrific fall in value due to the massive uncertainty that was imposed when lockdown came along. Certain market sectors as well, airlines, transport and so forth, showed some enormous reductions. But when you see the graph, what you can see is that by and large, real asset growth has actually got back to where it started at the beginning of the year. So not a great year, but nowhere near as bad as Q2 might have suggested. So overall, you might turn around and say that over 2020, assets may have turned in maybe a modest return, but not a disastrous return. However, that's only half the story. It's all about the liabilities. Because if we now look at the right-hand side, liability values are driven primarily by long-term government bond yields. And I've got the US 20-year Treasury spot rate on the blue line. And what that shows is that it started the year at about 2%, and it's currently dropped to just around about 1.5%. Well, big deal. Well, actually, it is a big deal, because a 0.5% fall in long-term discount rates, when you measure the liabilities over a 20-year period, that can increase the liabilities by 10%. So it is quite a big deal. Now, some liabilities also show some inflation linkage as well, salary increases, and to the extent to which they're either mandatory or ad hoc pension increases, they can be in some way loosely linked to price inflation. But the linkage is loose, and therefore the exposure is less. So if we take those 4 graphs and we come up with, try and illustrate what the potential path that a pension scheme's finances have taken during 2020 using some very high level assumptions, I will freely admit. However, it's instructive just to see what may have happened here. So if we start the assets and the liabilities off at 100%, and when I'm now looking at the graph in the bottom left-hand side, what we can see is that the assets in the blue showed a dip during Q2. That's because they have high exposure to real asset classes, less exposure to bond-related asset classes. But by and large, they've recovered and may turn in a return of 5 to 10% or something like that. However, the liabilities, because they are directly linked to these long-term discount rates, the long-term interest rates, they accelerated away during Q2. And indeed, although they've dropped back, we're still seeing an increase of 15 to 20% right now. Now, I've started both those graphs off assuming 100%. If your assets started off not at 100, but at 50, then you may have actually seen your assets increase to 55. But your liabilities at 100 have gone up to 115 or 120. So your deficit has actually increased. Even though it's nowhere near as bad as if we had actually measured in March, it's still quite a severe impact on the deficit by virtue of the existing underfunding and the high correlation of the liabilities to long-term interest rates. Okay, so that's the funding position, but what does that actually mean in terms of a contribution requirement? Because it's all about the cash, isn't it? Yeah, governments have to actually pay the cash, or it has to be met through some form of contributions in order to make this work. So what does that actually mean? So this is where the bottom right-hand graph comes in. The additional contributions here are on top of whatever was required at the start of the year. So this is all on top. And what it shows is that if you were to try and clear the deficits over the remaining 15 years, and also allow for the additional cost of accrual, because obviously accrual is also linked to long-term interest rates, then what you can find is that certainly in March, if you'd have done an evaluation there, it would have turned around and said that the scheme would have required additional funding over and above what it was already required to get, equivalent to 35% of pensionable salary roll. Now that's an horrific number. However, what you can see is that reflected massive uncertainty at the time, and that number has come down, but it's still around about an additional 15% of pensionable salary roll. So the big question is, has COVID worsened the situation? Well, based on our best estimate at the moment, which is the most up-to-date market conditions that we have, yeah, pretty much so. And the uncertainty continues because we don't know what the longer term implications will be in terms of life expectancy and lifestyle changes. In terms of how we might be able to then deal with this, one of my co-panelists has the dubious joy of being able to talk about that.
Thank you very much. Thank you very much. I think, Philip, you moved us from the shock to uncertainty, however, to some hints of optimism. And I think you opened this in the right way and the most realistic way. I'll move to Simon Herborn. Simon is an associated partner of AON. Simon, to what extent can parametric reforms of pension funds, increasing contributions, lowering benefits, increasing retirement age, etc., to what extent all these elements can save the government pension funds, which is $1 trillion question?
Well, thank you very much, Mr. Nejib, for the question. And firstly, please let me say that it's a great pleasure to be here today. And thank you also to Mr. Ibrahim for organizing this excellent opportunity and session. So I will take a few minutes to introduce the concept of parametric reforms and how they can be an important step in building what we could consider a future-proof pension system. So, as context, as Mr. Nejib, as you pointed out, and as Mr. Ibrahim also mentioned in his opening remarks, Many of the public pension funds across MENA have very high actuarial deficits. And in turn, this casts doubt about over their sustainability for the long term. So if we want to be able to preserve these pension systems for future generations of retirees, some changes are certainly needed to help make them more affordable and financially robust. And this is where parametric reforms can play a big role. Now, what I mean by parametric reform is essentially that we do not dismantle or fundamentally change the character of the pension system. Instead, we just make some targeted adjustments to its parameters to help make it more balanced. There are essentially 3 different types of parametric change that we can make. To explain that further, I have a short slide, which, is it possible to share that on the screen?
Of course.
Great, thank you very much. It's the next one after this. Could we proceed to yeah, great, excellent, thank you very much. So, there are 3 types of parametric reform, and I'll just talk through them very briefly. So the first and the most important type is simply to ask people to retire later, to push back the retirement age. This step is crucial. At the moment, retirement ages in the region are very low. For example, in Bahrain, data published by the SIO indicates an average retirement age of 48. And in the rest of the region, we observe something very similar, with many people retiring in their late 40s or early 50s. These low retirement ages may have been viable a few decades ago, but they're no longer viable under current conditions. This is partly because of rising life expectancy, which means that when somebody retires, their pensions are now paid out for longer. And it's partly because of falling fertility rates, which means the number of working age people who can pay in contributions is growing at a slower rate than the pensions that are being paid out. So some change is certainly needed to retirement ages. As a benchmark across OECD countries, the average normal retirement age for public pensions is around 64 at the moment. And in many cases, that is actually scheduled to rise further over time. So that gives us a feel for what might be an appropriate type of benchmark to aspire to. I mean, effectively, we have retirement ages at the moment that are around a decade earlier than our international peers. So that's the first and most important type of parametric change, raising the retirement age. The second type is just simply to pay lower pensions to retirees. Now, as context, the regional schemes currently have very generous pension plans relative to other parts of the world. As a data point, across the OECD countries, pensions are projected to be around 59% of final pay, and that's after a full career of, say, 35 or 40 years. By comparison, most GCC retirees will get pensions that are much higher than this, and also from a much younger age. For example, in KSA, somebody could retire after just 25 years and get a pension for the rest of their life as around 65% of their final salary. It's evident that these numbers are not sustainable. They're too generous, especially as we grapple with the realities of higher life expectancy and other financial pressures. So some changes needed to benefit amounts. In terms of implementation, that could involve changing the formula used to calculate pensions. For example, the accrual rate, which is a key building block. Or as another example, perhaps moving to use of a career average wage to calculate benefits rather than a final salary. And the third and final change, final type of parametric change is simply to put more funding into the system. So this funding could be from members or from employers or even from the government. Current contribution rates to pension schemes across the MENA are not actually that low. Most of them are in the range of 15 to 25% of pay, which is broadly in line with international norms. But in itself, this reveals the problem, because if we have people here retiring much younger and with bigger pensions, then to balance that, we should have considerably higher contribution rates rather than just the same contribution rate. And this is even before we factor in that in other countries, there is also income tax, which can help cover parts of pension costs. We don't have that privilege here. So when talking about parametric reforms, these three actions of changing the retirement age, reducing the benefit amount, and putting in more funding, or combinations of them, essentially represent the option space. Now, Mr. Nejib, please could we move to the next slide?
Yep.
Great, thank you very much. So when it comes to actually making parametric reforms, although it may seem simple, it's certainly not a straightforward or rapid process. So often it takes months or even many years of planning to move ahead. The first step in the process is typically to shortlist perhaps 5 or 10 different combinations of parametric reforms, and then do a detailed actuarial assessment of their outcomes to show, would those reforms substantially improve the long-term sustainability of the scheme. So that's the first step, to assess the financial impact. However, beyond this, we need to keep our eyes open to two very important other dimensions. One is the economic impact of making pension reforms. So for example, if we push back retirement ages, there could be an impact on the labor market. There could also be impacts on capital markets, on the level of savings and investment, on productivity, consumption, and so on. We could also frame this decision in terms of the cost of inaction. So if a lack of reforms means diverting public spending to pensions rather than, say, healthcare or education or infrastructure over the long term, then we need to understand that trade-off. So the economic impact, the economic dimension is very important. We also need to think about the social impact, though. For example, if we make reforms, will this have implications for income adequacy in old age? Do we need to introduce supplementary social assistance programs for low-income groups? And in perhaps a slightly more nebulous way, if there is a delay in making the reforms, do we potentially have social inequalities because it gets harder and harder to get fair intergenerational outcomes? So essentially, it's important to look at each of these dimensions, financial, economic, and social, in order to make an holistic assessment of what type of reform will be the best way forward. Now, I mentioned earlier that there have been widespread changes, parametric changes in other parts of the world. Within MENA, so far, the pace of change has been much slower, but there have been some countries that have moved ahead with important changes. A couple of examples that come to mind are Jordan, where a raft of changes has been made over recent times, and also the PASI scheme in Oman, in which various changes were initiated 4, 5, 6 years ago, maybe now. But more recently, one very striking example has emerged, and that's right here in Bahrain. I'm sure everybody is familiar with this, but I will give a brief recap anyway. So earlier this year, it was announced in the media that a wide range of pension changes would be put to the parliament in Bahrain for discussion. These are very forward-thinking steps that are aimed to safeguard the pension rights of future generations of Bahraini retirees. So these are very long-term proactive measures. And the steps included moving to a retirement age of 65 over a period of time, making some adjustment to benefit amounts, and also raising contribution rates. So it's exactly the three types of steps that we just looked at as the three types of parametric reform that could be made, and a combination of them has been created. My understanding is that this package of reforms is still under discussion, and it's not approved or definitive, but still certainly the discussion of these types of measures seems like a big step in the right direction, and it represents the types of change that we may need to be replicated over time across the rest of the region. So I'll just add one more thought, if I may, and that's on the final slide of this short presentation. Great, thank you very much. So we've talked about the merits of parametric reforms and how these can enhance financial sustainability. But it's important to keep in mind that parametric reforms can only be one component of the overall solution. We can't be too reductive about this. They're only one component of the overall equation. And that's because simultaneously, we should try to cultivate other forms of retirement saving. This is partly to give people the opportunity to top up their pensions, but more broadly, it can be seen as a step in trying to pivot away from the state being responsible for providing all retirement benefits, and instead passing some of this responsibility to employers and to individuals. I've tried to illustrate this in the exhibit on the left side of the screen. So the first column relates to the current structure of retirement savings in many MENA countries, which is essentially shown as a monolith of public pension provision. This is a simplification, but it's not that far from reality. Essentially, the very generous public pension benefits that are currently provided crowd out any need or demand for other types of saving, at least in the formal economy. By contrast, the second column illustrates what I would describe as a potential future-proof state in which we may have potentially a slimmed down and more targeted public pension benefit, but this would be topped up by additional savings from personal or employer-linked savings accounts, which could also be open to expatriate workers. Cultivating these additional saving channels is certainly not a small or easy task, but fortunately there are many examples from other parts of the world that we can learn from in terms of structure and incentives and financial education and so on. For example, in New Zealand, a program was rolled out maybe a decade or more ago called Kiwi Saver, which has been very successful. In the UK, there is a new nationwide workplace saving platform called Nest, which has also been very successful. So these types of framework are needed on top of a parametrically reformed system. So I'll leave it there, but if I was to sum up, it's essentially that the key message is that parametric reforms are needed to get the region's public pension systems back on track financially. And what we see in Bahrain is a great example of that. But such reforms are only one component of a broader move to a future-proof state.
Thank you very much, Simon. I think you brought some elements of answer to this very, very important set of questions. Pension funds now is characterized by deficit. Response to that is reform and adjustment, as you said. But I would get back to the initial question. Can parametric reforms save the pension funds? And as you know, now we'll be running a polling question for 30 seconds. I don't know if you see that. The results will appear instantly, as I understand. Okay, that's great. So I will ask the speakers on the results of the polls to make the few comments. But before that, I will ask my friend, Mr. Hazem Abdulrahman, the actuarial consultant of Mercer, United Arab Emirates, to take the floor and enlighten us, Hazem, on Mercer's annual World Pension Index results that were just released 2 weeks ago. Any remarks on those results and their insights on this index? Thank you.
Sure. Thank you, Mr. Nejib, and I would like to thank Mr. Ibrahim and FinTech Robots for this great initiative.
Maybe we could, you got my question, you can work on it. Can we have a few seconds to finish the poll first?
Of course.
Because I'd like people to focus on what you are going to say, Hazem.
Definitely.
Thank you. You are having a look at the poll, the questions? Everybody?
I got a couple of questions. Are there several more? Or?
No, just 2 questions.
Okay. That's an easy poll.
Okay. I think we have to wait for all the delegates to answer these. I have another 10 seconds to run, and then we'll be all ears to my friend Hazem Abdulrahman. Yeah, all the delegates, I hope they have contributed to this poll, as it will be an important tool and instrument for our findings and the continuation of our discussion on this very important matter. Yes, I think you all see the results on your screens. Do you?
Yes.
No.
Okay. I mean, this is faster than in the American elections polls and the counting. So, okay. Now, I think if, I don't know, I think we should now listen to Mr. Hazem and maybe comment on these results later. Okay? So, Hazem, please.
Thank you, and thank you, Mr. Nejib.
You got my question, or I don't need to repeat it?
Of course, no, it was with regards to the recent release of the Mercer CFA Institute Global Pension Index Report. And so over the next like 10 minutes, I'm just going to give you a bit of a background on the index, the approach that is being used. And from there, I will share with you the key results of the report and the impact of the pandemic on that index, followed by some global reform themes.
All in 10 minutes.
Yes. So if I'm just going to ask if we can pull out the slides, Mr. Nejib.
Sure.
So to give you a bit of a background on what is the index. So the index started back in 2009 with 11 countries or 11 retirement income systems. And over time, that number of countries covered increased to reach 39 countries. So now we have 39 different retirement income systems across the globe, presenting more than 64% of the world's population. And when it comes to the Arab countries covered in the index, the Kingdom of Saudi Arabia is the only country currently being part of that analysis. So the objectives of this pension report or index report, first, number one, it's to be able to benchmark retirement income systems across the different countries. To number two, to highlight some of the shortcomings in each system and to suggest areas of reform. There's no doubt that programs and practices that are adopted in some countries are very valuable lessons and provide good ideas for the development or reform of pension systems in other countries. So this is a very high level background on the index and the objective of it. So if we continue to the next slide, now I'm gonna talk a bit about the background or the framework that is being used to score each country in the index. And that framework is actually based on the World Bank multi-pillar system framework. It was initially recommended in its influential report, which is called Averting the Old Age Crisis. So if we can scroll to the next slide, please. So that 5-pillar approach provides a good basis for comparing retirement income systems around the world. And if we take a closer look at those pillars, you can think of them as a building block of the retirement income. So we start with pillar 0, which is a non-contributory basic pension. It can be universal or means tested. For example, having a floor or a minimum income at retirement that is not linked to your earnings. From there, we go to pillar 1, which is a mandatory or a mandated public pension system. It is publicly managed with contributions linked to earnings. So that's very similar to the state pension plans that exist in the region over here. From there, we go to pillar number 2, and that's a fully funded occupational pension, or what we call a private pension. That pillar is not that common in this region. And from there, we're going to go to pillar 3, and it is a voluntary or a funded pension plan. Again, those are not that common in the region. Last, we go to pillar 4, and pillar 4, it's a voluntary system that gives you an access to a range of financial and non-financial assets, such as support from family members, healthcare provided by the country, or housing programs offered by the country. So in general, those are the 5 pillars that are taken into consideration whenever indicating a score to each country. So jumping from there, we would go into to discuss how we calculate the score of each country. So there are over 50 indicators that would fall under 3 fundamental questions, okay? And since its inception, the Global Pension Index grouped these desirable characteristics or the indicators into number 1, adequacy, number 2, sustainability, and number 3, integrity. So if we look at the first sub-index, the adequacy of the benefit, so you can ask, what do you get out of this system? Perhaps this is like the most obvious way to compare systems, right? So what are you getting out of it? It's again, like the primary objectives of pension systems is to provide an adequate retirement income. That sub-index was given a weight of 40%, given the importance of it. Then if we look at the second sub-index, which is the sustainability, and if you want to ask that fundamental question, how far long can that system keeps on delivering, right? So there's a huge concerns across different countries, especially in light of that aging population, the increasing old age dependency ratio, the increase of public expenditure on pension plans, and also the increase in government debt. So overall, that sustainability sub-index was given a weight of 35%. Then we're going to go into the third sub-index, and that's the integrity, right? And if you want to ask that fundamental question, it's going to be like, can this system be trusted? And it's very important to know that it's very important for the community to have the confidence in the ability of that pension sponsor or pension provider to deliver on their future promise to pay these retirement benefits into the future. And overall, that sub-index was given a weight of 25%. So overall, the score or the result for each country would be the weighted average of these 3 sub-indices. Now, if we go to the next slide, please, and let's have a look at the key results of the report. So under the adequacy sub-index, Netherlands, Denmark, and Germany had the highest scores, while India, Thailand, and Mexico had the least scores. Okay, so under that sub-index, there's a bunch of indicators that can influence this score, but the most important indicators are the minimum pension provided and the net replacement ratio in that country. So from there, we would look into the sustainability, or how long would that system keep on delivering. Again, Denmark and Netherlands and Australia scored the top or had the highest scores, while Brazil, Austria, and Italy had the least scores. And if we look at what kind of indicators that influence that long-term sustainabilities of the system, there are a bunch of things, but the most important are the level of funding, the length of the expected retirement, both now and in the future, the labor force participation rate, especially within the older population. And then if we take a closer look, also there are the current levels of public pension expenditure and government debt, as well as the real economic growth of the country itself. So these are the main influence indicators under that sub-index. Now, if we go into the integrity considers three broad areas. Number one, the regulation and governance. Second, the protection and communication for members. And third, the operating costs. And for that, Finland, Norway, and Netherlands had the highest scores, while Argentina, Mexico, and the Philippines had the least scores. And overall, if you want to combine all these three indices, there were only 2 countries that out of the 39 that scored above 80, or if you want to give it a grade, they had a grade A, and it's the Netherlands and Denmark. And if you want to describe the Netherlands and the Denmark retirement income system, you can describe them as a first class and a robust retirement income system that delivers good benefits and sustainable with a very high level of integrity. Now, just like for those who are curious about the grade of the Kingdom of Saudi Arabia, Kingdom of Saudi Arabia received a grade of C, which translates into a system that has good features, but also there are few shortcomings that needs to be addressed. And without addressing these or working on improving these shortcomings, the efficiency or the long-term sustainability of the program can be questioned. So if we go to the next slide. So if we look now at the impact of the pandemic or COVID-19 on the retirement income system or the index itself, on the short term, the sustainability sub-index across all countries was hit, and it was lowered by an average of 1.2 points. Now, if we want to look into the future, the index or the scores of countries in the future can also be hit due to certain things because of the pandemic. For example, it's possible that the Social Security pensions can be reduced, a reduction in coverage, especially in the private sector, a reduction growth in the pension plan assets, or a greater leakage of the pension plans prior to retirement. So that would give you an idea of the impact of the pandemic on the index. And lastly, I know I'm running out of time. Just like quickly, I'm going to go through the main themes or the global themes of reform that were mentioned in the report. So,
1 minute, please, Hazem.
Yeah. So first, just to increase the coverage of employees, especially of those individuals that are self-employed or in the private system, increase the state pension age, promote higher labor force participation, especially at older ages, reduce the leakage of the retirement saving systems, and encourage or require higher level of private savings. So in a very high level, those are the main outcomes of the pension report, and like it's available on the Mercer website if whoever wants or interested to read it. And I thank you everyone for your time, and back to you, Mr. Nejib.
Thank you very much. Very interesting, Hazem. I think you gave us very important indicators. I mean, let me just go through the some countries that you referred to in good and less good results. I would say I would find the same countries that we have been referring to as the I wouldn't say the good students, but those who have a decent performance in terms of managing their pension strategies. Netherlands, Germany, and Denmark, in opposition to India, Thailand, Mexico. Again, Denmark, Netherlands, Australia, in opposition to Brazil, Italy, and others. In terms of integrity, we find again two Scandinavian countries, Finland, Norway, and Netherlands, in opposition to Argentina, Mexico, and Philippines. One remark, we can say the good performances in general are within countries with small populations, which are in political science easier to manage. I think you have given us very important food for thought. Thank you so much. Now, last but not least, I will move to my friend Iyad Hourani, managing partner and actuary for Sites Advisory Solutions. My questions are DB pension funds still fit for purpose in today's current accelerated demographic and labor market changes?
Thank you, Nejib. Thank you for all the panelists, and thanks for Mercer and FinTech Robas for this invitation and this opportunity to reconnect and talk about this important topic. Nejib, I think I sent you relatively late a presentation, a few slides, but I can share my screen if you don't have it.
I think our friends will handle that. Can we?
Okay. So to answer your question, it's a yes and a no in terms of whether DB plans still have a role to play.
So I'm told that they don't have it, so you can use your screen, my friend.
It is it's disabled. I cannot share.
Use your slides, please.
Yeah, the share screen is disabled for me.
Can we enable it for him, please? Yep. 1 minute, they say, okay?
Sure.
Well, you can talk. You can
Sure, certainly.
be more eloquent than the slides.
Yeah, thank you. So actually, I mean, yes, there is potentially a role for DB, certainly not the way they are set out and now in the GCC area and in the MENA region, and certainly not with the final salary DB design system. But as probably, I mean, we don't want to bore people with technicalities, but DB plans are much more than final salary. When Simon or Hazem talk about basic or means tested pillar 0 pension, this is a defined benefit design. When we talk about career average, adjusted career average, this is some sort of defined benefit plan. Even those countries that have their main pillar or component based on defined contribution, it is actually a hybrid system whereby they have some minimum guarantees that are integrated within these systems. So there is always room for DB plan, but certainly, again, not the way they are set up in the GCC and the MENA region. I'm gonna just double check whether, yes, I think I can share my screen now. Are you seeing?
Yep, yeah, very clear. Yes, yes.
Okay, great. So let me go back to the beginning. Basically, can DB plan remain relevant in a pension system and a retirement system, and what's the way forward? Some of the main success criteria for retirement systems, Simon have discussed some of those, Simon, Phillip, and Hazem as well. We're talking about adequacy, we're talking about affordability, sustainability. I want to focus a little bit more later on in the presentation about robustness and agility of these systems. Now, to answer the question, do we go with a DB plan or a DC plan, a single gear or a multi-pillar pillar approach? If we look at a sample of a few countries, and at the far right, we have Saudi Arabia and the GCC in general. And here we have the Mercer Melbourne Pension Index scores. These are those of last year. So Hazem, if these are not up to date, maybe there are some small changes, but certainly something that pops out is that most countries that are scoring relatively well or quite well, they are using a multi-pillar approach. Something that in the region we are not using. Typically, let's focus mainly on the GCC, but this applies to most MENA region countries. There's the Pillar 1 system, social security system, government sponsored. In most countries, it's a final salary DB. This system has been used or utilized to play multi-roles. It's playing part of the Pillar 0 role. Certainly, it's playing the Pillar 1 contributory pension system role. It's also, as Simon pointed out, it's playing also a Pillar 2 role, and basically taking most of the room for the need for a Pillar 2 system or occupational pension fund. It's also used to settle and to address unemployment problems. I mean, we have seen in Bahrain a year ago, the early retirement voluntary program. This year in Oman, there has been a retirement program also that has put to retirement a lot of people. Countries in the region have been using this program to make room for newer generation because of, I don't want to say lack of opportunities for nationals to enter the job market, but to address part of this problem. So the way forward is a combination of the challenges we have discussed it, the fact that retirement ages are way too low, the balance between the financing and the actual benefits that are promised is a total debalance there. The fact that we are dealing with a final average DB pension, it makes it that the sponsor, the government, is bearing basically all the risks that are associated with a retirement system. And point number 5 relates to the robustness and the agility of criteria. Point number 5 is also the fact that the current laws are very static, and this prevents the ability to adjust to a rapidly changing demographic and economic environment. And this is something that needs to be addressed apart from all the other changes. What is changing in terms of population, labor market, and what has COVID-19 and the current pandemic showed, or actually made sure we have a full attention on those facts? If we look quickly at the UAE national pyramid, we see that the tranche of population that is under 20 basically is double to triple the number of people that are currently in the labor market. Here we're talking about nationals only, we're carving out expatriates. This means that, and this is relatively similar in the other GCC countries in terms of weights, not in terms of numbers. And this means that the future generation in the next 10 to 15 years, you have 3 times more people than the current numbers in the labor market that are entering the labor market. These guys, these women and men, talented, they need opportunities. We know government is not gonna be coping and providing opportunities for that. More and more, and what COVID-19 has showed us, people will be working remotely, will be able, and with technology, will be able to have multi-sources of income. So the current structure of the, regardless whether it's a DB or not, the current structure of the system, whereby it covers the formal sector of somebody who has a full-time employment in the government or in private sector, this needs to change. What I want to point out in terms of main titles to take out of this, in terms of way forward or in terms of transformation, certainly we have a system that's been in place for a few decades, and we need to deal with the legacy of the current system for the current members. And this needs to be through parametric changes and maybe some minor adjustments that are implemented retroactively. So for example, even for current member, if you start gradually increasing retirement age, this has a retroactive impact on acquired rights, etc. So parametric reforms that Simon has discussed, I mean, these are absolute necessity, but they don't solve the problem. We need to rethink the whole retirement system, national retirement system, in a structural way. Revisit the strategy and the policy in question. What do we want to provide in terms of benefit? What kind of benefit at which ages? What is the longevity of the career for people within the labor market, within the economy? This is very important. Certainly, when we're talking about social security, the pillar 1, the contributory system, this needs to be, its size needs to be shrink down, similar to the slide that Simon showed, to a level where there's room for other pillars to play a role. We're talking about pillar 2, we're talking about pillar 3. Up until now, some of the critical incentives to put in place pillar 2 and pillar 3 are the fiscal advantages that did not exist in, let's say, at least the GCC region. Just lately, 2-3 weeks ago, Oman announced that in 2022, income tax will be introduced. I suspect that many countries, maybe Bahrain, maybe others, will start following suit. So there will be room in the future for these pillars, and the fiscal and the other type of incentives will be there for them to play a role. So limiting fragmentation for the pillar 1, adopt and fair and balanced pension design. So here we need to move away from final DB salary and maybe focus, we're talking about pillar 1 here, focused on adjusted career average designs and NDC, and use a multi-approach, multi-pillar system. And as you have seen, whether from the Simon intervention or from the Mercer report and other reports as well, you can see that there's no one-size-fits-all solution. We have noticed that both of these countries, they have a Pillar 0 basic pension or means tested pension. There is a role for the Pillar 1 Social Security contributory pension, and then there are these other pillars or systems that are integrated and complete each other. The third and the most important, or as important as the other one, is that this system and the laws that are put in place need to be robust and flexible. They need to be able to allow people to have multi-sources in country and outside the country, multi-sources of income that are covered within the system. And the world is changing. We don't know how it's going to change. Certainly, Phillip has pointed out to this. And when we talk about robustness and flexibility, we're talking about risk management policies and a modern funding policy that really plays a governance role that is super important, whereby it triggers certain action and certain government decisions upon reaching certain thresholds. And this takes out that political paralysis of having to take a decision to introduce parametric reforms in that structural reformed retirement system. So this is more or less what I want to say.
Thank you, Iyad. Thank you very much.
Thank you.
This is very important. I don't know if you have seen that we start to raise the attention of some delegates, some attendees. We have two questions that I will put to all of you. Do you read them? Can everybody read the questions?
No.
When reforming, let me read the first question. When reforming parameters, how do you treat perceptions of fairness? For example, setting a threshold, example 2030, where retirees will have a lower benefit than those retired prior to 2030, might raise unfairness issues. I hope you got the question. I will leave it to you to react to that. Let me try to put it in our chat, so maybe you could have a look at it. Okay. Then the second question is, if you can open your Q&A section, you'll see the questions. You got it?
Yeah.
Okay, then I don't need to read that. You have the two questions.
So this is Simon here. If you like,
Yes.
I could try to answer the first
Go
question.
ahead, Simon. Thank you.
So I think it is, it is a very important question. When we make reforms, they do need to be fair to people. They need to be fair to people within the same generation and also fair to people between different generations. We have intergenerational fairness. So fairness is also very important, and so is also simply the perception of fairness. Public people impacted by these change would need to be convinced that the reforms are fair. So I suppose the way to achieve fairness between, I think the question is primarily around having fairness between generations. I think the solution is to have very carefully designed reforms that build in what we could call gradualism. So in other words, these reforms would be, rather than being implemented sort of on a cliff face, and suddenly the retirement age, for example, goes back to 65, they would be phased in over a period of time. For example, it could be 10 years, it could be 15 years, it could be even longer, so that we gradually move towards the new norm over an extended period. That will mean that it won't be too disruptive to people that are already towards the end of their careers. somebody towards the end of their career won't have their retirement plans altered massively, and the younger generation will have enough time to kind of react to those changes and plan the rest of their career accordingly. Plan for the fact that they'll have to work longer, or if it was in the instance of reducing benefits, the younger generation would also have time to build up supplementary benefits to top up their retirement income if they think what they will get from the new reform system is inadequate for them. So I think the crux of it is, maybe what we could call gradualism, implementing, making sure that we introduce the changes, at a slow pace over a period of time so that we get fair intergenerational outcomes.
Thank you. Who would take the question? Do the panelists believe that these DB funds will remain the way they are in future, in the next 20 years? Let's have brief answers. We are running out of time. Who can take that?
I can give you a very short answer, which is, I guess it depends on political willingness to tackle what is a very tricky issue. It'd be quite easy just to be able to allow the funding of these schemes just to run off and for them to become pay-as-you-go, similar to many pension schemes that exist certainly in Western economies, unfunded public sector schemes. However, that raises an issue of whether or not you have sufficient income and resources as a government to be able to eventually meet these liabilities that you are accruing. And so that is the issue, whether or not you decide to tackle them in the next 20 years or you actually decide to tackle them in 50 years' time.
Thank you. That's very to the point. We have a question from Ghulam Mustafa. Please explain modern fund policy.
I think this refers probably to my last slide or the slide before last. When we're talking about funding policy, if we look at Pillar 2 OECD occupational pension funds, most of the regulators in these jurisdictions, they have put targets in place for full funding or near full funding. And whenever you are short of that, there's some catch-up contributions that need to be done. For Social Security in the region, there are no proper funding policy whereby, okay, we have laws, we have benefits, we have a mandated contribution rate, and there's nothing that tells us what needs to be done if 5 years down the road, 10 years down the road, we're on target or we're not on target. It's like having a company saying, okay, everybody, all my employees need to be on time in the morning, but there's no working hours specified. So a modern funding policy also integrates risk management and automatic adjustment mechanism. It's some sort of recipe whereby it tells you for Social Security, you don't need to be fully funded necessarily, but you need to be sustainable over the very long term. And you have certain targets that are put in place and actuarial valuations that are currently done. They are done based on some generally accepted benchmarks. Then these will be done in accordance with the specific country-specific funding targets and different KPIs that are put in place. And the actuarial valuation will be able to tell you whether you are on target or not. And the funding policy will specify what are the mechanisms and the triggers and the actions that need to be done in case you are off target, okay? It can be if you have pension indexation, or it can be if you have career average adjustment systems, you're off target before thinking about necessarily increasing retirement rate or increasing contribution. You can freeze or delay certain indexation of the system's parameters. So, but basically a funding policy It works hand in hand also with the investment policy. It's a way for better governance, for better risk management, and gives the way forward and the recipe for the decision makers to take the right decisions at the right moment, without and taking out this paralysis of parametric reform.
Thank you. Thank you very much. Now, we are running really out of time, and I think we have some specific questions, although the attendees are anonymous. Who would take the following question? Do you have any idea on the new reform made on the pension funds in Bahrain? And do you agree to the steps taken for sustainability of both public and private pension funds? Maybe you could link it to another question. How do you think we can balance the need to reform in the pension system in the GCC countries and the need for pension increase to meet economic changes? Okay, who could take this one or the both questions, as Bahrain is in the GCC? Okay, Philip, maybe?
Sure. So it's a useful first step. Like with all of these things, we will see developments in demography and financial conditions going on into the future. And certainly for a range of different systems, as we saw in the Mercer index, you need to have a wide range of pension pillars in order to be able to allow your population to plan and implement effective retirement planning. So yes, we all need to have a core level of pension provided by the state, but then you also need those other elements with which to be able to then plan effectively and to give people the time to do it. And when you're making a change, to communicate effectively the reasons for the change so that they understand why it's fair. A lot of the issues that exist within the Middle East region, a lot of the structures were set up 40, 50 years ago when demography was different, life expectancy was different. It's perhaps no surprise, therefore, that they aren't exactly appropriate in today's environment when people are living longer, they change jobs more effectively, and so forth. So a useful first step, but it has to have the flexibility with which to be able to cope with future changes.
Yeah, thank you. Could I ask Simon to give some additional ideas, as we heard him show some interest and I would say knowledge on Bahrain? Thank you.
Sure, of course. So in terms of the reforms in Bahrain, you know, and I should preface that all of my comments are based on just public media statements. But in terms of the reforms in Bahrain, my understanding is that the key measures are pushing back the retirement age over time, I think towards perhaps 65, but over an extended period. Making some adjustment to the benefit amount, the formula used to calculate pension benefits, as well as making the indexation of pensions in retirement, so the annual increase that is awarded to pensions, making that conditional on the financial position of the system. And then thirdly, making some kind of raise to the contribution rates. So those were the key parametric changes that were included in the Bahrain proposition. I think on top of that, there was also some additional measures which sounded, very sensible around preventing concurrent pensions and salaries. So sometimes people in, some MENA countries are able to retire from one pension system, but continue to work and therefore have a pension and a salary at the same time. The purpose of the pension is meant to be to provide you with an adequate income. So it shouldn't be necessary to have a pension and a salary together. So there were some other kind of measures connected to that, as well as, I think, integration of there are two pension funds in Bahrain, one for public sector workers and one for private sector workers. I think these funds were due to be consolidated. And that was another measure. So those were the steps taken in Bahrain, and those really, at least from a parametric reform standpoint, do seem like the right kind of steps. And that's based on the information in the public domain about the finances of the Bahrain pension system and the fact that there is a big actuarial deficit, and there are question marks about how long it can remain solvent for if these changes are not made. So if these changes are not made, then either the scheme goes insolvent over a period of time and pension benefits are cut, or the scheme would require very substantial additional support from the government. So I think that's the lens that we need to look at it through, that the scheme is currently under a lot of financial pressure, and so changes like this are perhaps necessary. I do think alongside these parametric reforms, there should be perhaps some other measures to introduce other types of saving. So these would be an important complement to the parametric reforms that have been suggested.
Okay, now we're really running out of time, and I will give each panelist 30 seconds to make final remarks. But if in your final remarks you magically could take the following questions, I would appreciate that. And then I will reassure our attendees who put actively and very important questions that their questions are noted, and then some of them are asking the panelists to send their slides or their presentations. I will make sure that this will be done. Let me read the questions for Annie. So the question: do you believe we will see more DC occupational pension schemes, such as in Australia and New Zealand, in the region? The other questions: were any of you involved in the recent reforms made to the SIO pension funds? If not, could you provide your opinion on its pros and cons, if possible? In the current environment where the interest rates are low, do you see pension funds borrowing at lower rates and use the attractive spread of increase their funding ratios? I mean, there are various varied questions. I will, I think, inverse, and then please 30 seconds, not more, as we are going to close. I will start with Iyad, of course, and then Iyad, 30 seconds, please.
Yeah, very briefly, and this maybe points out to one of the questions. I mean, apart from what we've discussed, certainly there needs to be an awareness campaign to the public and to the leadership about what are the main issues and why things need to change. And they need to change, transition in a gradual way. When we were young, we were hearing in the States and Canada about Liberty 55. We know that this does not exist for our generation. And the current generation that is coming up, they cannot really expect to have the same benefits as their elders. Things will change, labor market will change. People need to be aware how this is changing and why the retirement system need to be restructured for their own benefits in order not for everything to collapse.
Thank you, Iyad. Hazem?
Thank you. So in brief, I believe that there's going to be more expansion on the different pillars that exist. Just echoing on everything that was mentioned today, moving from one pillar to multiple pillar approach, I believe is going to take place. Just like echoing on the question, if more DC occupational pension schemes might pop up in the region, I believe so. And that's also, I think the DIFC, even though it was for the expatriate population, did prove a great pilot so far. So with that, I think there are changes that are going to take place in the near future.
Thank you very much. That's very, very straight to the point. Simon?
I'll just have one remark on one topic, which is about the emergence of DC vehicles. This seems like a very positive and necessary step. There should be additional channels open to both local citizens and also expatriate workers to make savings in DC funds. So I think the emergence of DC funds in the region over the coming decade or two would be a very positive thing.
Thank you very much. Last but not least, I will turn to Philip.
Yes, I guess my point is that investment won't save your defined benefit pension fund in the current situation in which you find it. Investment, yes, can have a magical impact. You might be able to get a slightly more efficient return through diversification, private equity, private debt, or through risk management processes like ESG. We're seeing a big development in that. However, if your assets only cover 50% of your liabilities, gaining another 0.5% per annum for unrewarded volatility won't actually bridge the gap. It'll get you perhaps another 5%, maybe 10%, but it won't get you 40%. And that's where the additional contributions or parametric reforms are vitally necessary.
Thank you, Philip. Thank you so much. I'll remind all those who put questions, all the slides, all the presentations will be placed posted on the website of the conference, and all the questions that we didn't have time to answer would be answered also. Let me thank all of you, those who are on screen, those who are behind the screen, who have done this great job. I will also make a final call. I would say, as you know, I do believe that this problem that you are raising in a very, very technical way is highly political, is highly important for the future of humanity, for peace and security within countries, within regions, and globally. And that's why Ibrahim, my friend Ibrahim, and I have been for the last few years trying to raise this issue to the multilateral system, as we believe that the government and private sector and the trade unions, governments, private sector as employers, the trade unions are as defenders of workers and employees, have to join hands and work together and create a pension strategy framework based on prudent foresight, population structures, and sound economic policies to address these pension crises. They are plural. And now, before it becomes too late. And I would pledge that the International Peace Institute, with all of you, from our headquarters in New York, working hand in hand with the UN Secretary General, with the Economic and Social Council, with the Security Council, with all specialized agencies, we are ready to place this very important issue at the top of the agenda items of the international community. I will stop here, and I hope you will follow up with Ibrahim, and we cannot thank him enough with his all his team for having brought us together. We have to work together to bring this up to the level it deserves, at the attention of the decision makers at the country level, regionally, and internationally. I will remind you that the next session on the cost of economics and pensions, economics of pensions, will be held at 15 hours today. I will hope that we will see you there, and enjoy your lunch, and see you very soon, hopefully with more involvement of governments, private sector, and trade unions. These are the triumvirate for a solution of this very important matter, that I will thank you so much for having opened our eyes in your details, in your technical presentation. And thank you again, Brahim. You are behind the screens, but you have been present in our minds and our deliberations. Thank you so much, everybody.
Thank you, everyone.
Thank you.
Thank you,
gentlemen. It was a pleasure. Thank you, Mr. Nejib.
Thank you all. See you soon.
Thank you.